All right, everybody. Appreciate everybody's patience while we got everything set up. It was my fault. We are late half an hour. I am completely gassed, but I definitely wanted to make sure that we put on a show for you guys. I excited to knock this out, have a good conversation with Mr. Patel, talk about the markets as always, and then have something delicious to eat and hit the sack because I have an early morning again tomorrow. But overall, markets are looking pretty healthy, man. Rocket Lab was up again today. My portfolio is at all-time highs. So things are looking pretty healthy in that respect. So I appreciate everybody being here. October 2nd, 2025. Bitcoin back on a rally, 120,000. Oil hitting just above $60. Henry Hub at $3.40. And then we'll go down the rest of the list, like Apple. That is back up into the three. I think it hit two. Let me see. What did she say? 257. Amazon's 222. Dutch Bros 5250. Google 246. So almost back to 250. Palantir almost back to 190. Rocket Lab $52. SPY 6700 on the S&P 500. Ladies and gentlemen, Q's 607. And Bitcoin. So, Mr. Patel, sorry for my little intro. How are you doing?
So, a funny story. So, I was on Amit's stream, and I thought the mic was done, and I thought Amit had closed the stream. So I said, "So, guys, what are we dumping today?" Because like the market's up. Because like when the market's up, you kind of want to say like, okay, like, are there anything you want to take down, right? So basically, I was like, the part that everyone missed was I was trying to say like, so when are we dumping everything and going into cash, like as a joke, but I think people heard that and they're like, what are you dumping, what's going on here,
Yeah.
So yeah, no, I just at some point I do feel like we're gonna have to take risk off the table, like I like this market, it's running, it's doing its thing, but Q1 Q2 there could be some turbulence. And I don't know, like that's something we have to just keep our eye on. As of right now, everything is working. One of the things that's been working recently that's been helping. By the way, did you get a chance to buy any of those healthcare companies when I messaged you? No? Okay.
I did not.
That's fine.
No.
Yeah. We may want to take a look and just do that tomorrow. And I'll show you guys what I'm talking about. So this is something that I spoke to, what do you call it, with Sam and even with Amit. A lot of the healthcare names are starting to kind of make their run today. Humana reported that they're reaffirming their guidance. So, a lot of these managed care organizations, they've been sold off significantly because of some of the changes around reimbursements rates for Medicare, and also the cost pressures that they're under. Well, it seems like a lot of them have been able to get a better understanding of what their costs are going to be for next year, and they raise their prices accordingly. And because of that, they're sort of now getting into the zone where they're going to be able to get back to profitability. So according to Humana, their profitability is going to be like somewhat restored by I think like 2027. So if your time horizon is long enough, this is a really great industry to be in terms of as an investor. And so I'm trying to log into X so I can show you guys. 1 second. I can't even get in. All right, whatever. So if that profitability gets back to normal, it'll like I said, these are nice recovery plays. And during a recession, if we do get a recession next year, you kind of want to be in something that's a little bit more defensive, right? So if you look on a 5-year chart, you can see like this nice upward steady progression. And then the last few years, things have just been kind of going down. And on a weekly basis, you can see like there's been some buying interest. Let me just bring it up on a daily and 1 year. Sorry. A 1 year. So you can see here, it kind of went up to like 309 and then went back down to 256. So if they can get their guidance back to normal, they could really like get back, to a much higher value. So, and if you look at like their volume profile, you can see that there's been a lot of buyers here, but then there was also a lot of buyers in the last 5 years in this range. So over time, they're going to definitely be like hitting resistance zones and basically climbing that wall of worry. So like over the last 1 year, majority of the buys happened right here at 256 and 269. So there's like a nice floor that's right there. That
people are wondering what you're thinking with respect to defense. Are you thinking consumer staples? Are you thinking banks? What are you thinking?
I'm thinking managed healthcare. Reason why is because, you know, regardless whether or not you have a job and the economy is this, that, and the other thing, you're going to need healthcare, right? So if you have the ability to generate cash flow during weak times, that's where you want to be. So healthcare organizations like health insurance is a defensive sector, you know. So I think that's where I'd probably land, because the value here is insane. If you look at, let me just bring up the, give me 1 second, sorry. If you look at the valuation trends for managed healthcare, like let's just look at Humana, right? If you look at the financials, the first thing that I like about this business is that it has a very up and to the right business revenue model. You know, if you look at healthcare spending in general, healthcare spending always goes up and to the right. You know, members always going to have more expenses and everything else. So if you look at like the total revenues for this industry, you're going to see that even when there's like periods of weakness internally at the company, it's a nice up into the right business, right? So that's like the first thing. So you see here, even during recessions that we've had or like market slowdowns, literally it's up and to the right. So this is the first positive thing. So recession wise, even if we get a recession, healthcare spending is going to stay normal. It's just a natural part of the cycle. And you can see that among like, even, let me see if I can find the chart, Yardeni charts, and then sorry guys, healthcare, managed healthcare.
But while you bring or do you have it? I was gonna say, okay.
Yeah. So you see this right here, forward earnings. You see how it usually stays within this one band gap. All of a sudden now it's kind of fallen off. So eventually in the next couple of years, we're going to start to see these organizations. They have a short turnaround period on improving their margins, because they essentially can just raise prices, raise premiums, control costs, and they'll get back to normal again. So if you look at the valuations on these things, like forward profit margin, this is the main challenge. So their profit margins have literally been around 4 to 5%. Now a lot of them are trading at right here around like between 2 and 3%. So once you raise premiums and you control costs, these margins over the next couple of years will steadily improve and get higher. So if you take the current revenue, you give it that 5 to 6% growth, whatever it is, depending on which insurance company, and then you apply a more balanced like profit margin that's more historically accurate, you're going to see that profitability comes back. And a lot of these companies, even on a net income wise, their net income has fallen off, but their operating cash has been actually pretty good. And so a lot of them, what they tend to focus on is acquisitions. So they pay a lot of money for acquisitions, but right now it makes more sense to just buy back their own stock while it's super cheap. So that's what a lot of them are going to go ahead and do that. So from a defensive standpoint, this is a great sector to kind of park some cash in. On a forward basis, like you see this PE kind of like go up like this, right? That's because a lot of them had to restate their restate their earnings and stuff. And so their PEs are going up, but it's like the thing that we spoke about the other day. It's a false flag, right? So as your share count goes down, your PE is, of course, not share count. If your share price goes down, your PE is going to go down. But then when you report our earnings like under overwhelming earnings, the PE is going to climb up and it's going to give you this false flag that, oh, look, this thing is actually expensive, but it's not that expensive. So, yeah.
Yeah, I think one of the things that I always want to bring back to the channel is like we're kind of entering this place of a different part of the business cycle, and so I think this is probably prudent to bring to everybody's kind of attention, right? And depending on upon where you are, and this is an example, right? So don't necessarily look at where the US is on this map and be like, oh, we're still early, right? So this is an example, and this particular is from the second quarter of 2021. But basically, you can classify these things into the early, mid, late, recessionary. And with each of these, right, you have easing of certain things or tightening of certain things. And within those, you'll have certain sectors that perform better or worse. And that's kind of what Chris is talking about with respect to maybe it's time to take things out of the high, super speculative growth and maybe the technology pieces and get into things that are slightly more defensive. Because as you kind of move into the latter recessionary piece of the business cycle, you're going to have falling activity, credits drying up, right? We're kind of already starting to see that. Profits are starting to get a little bit difficult. Sales are starting to get a little bit more difficult. People are starting to have layoffs, etc. We're really starting to see, that kind of late to recessionary start of the business cycle, it seems like. But that's not to say that every country is going to be in the same business cycle at the same time. It's not to say that every sector is going to be in the same business cycle at the same time as well. So I think that this is just something that's kind of important to note. And another piece about this as well, and this kind of just demonstrates like certain industries perform better during certain times, and some of them are slightly, what's the word I'm looking for? Some of them are more resilient across the entirety of the business cycle, and some of them are more cyclical, right? So when we talk about things like utilities or energy or like semiconductors, things like that, those things might be slightly more cyclical, and you need to focus upon when you maybe enter and exit, right? I have been an advocate for a lot of the past 18 to 24 months to not really be focusing on short-term oil and gas, and focusing on like picking up for like the AOCIs of the world, when a lot of people are like, oil's going back to $90 or $100. I just didn't see it. I think the world is awash with oil. I do a lot of studying on this, obviously. And so for me, now that I'm starting to see oil is getting challenged, people are cutting buybacks. I think it's only going to get worse from here, honestly. But I've actually started to dabble back into that because I've started to see some issues and breakdown of people's sort of buybacks and things starting to get a little bit tighter. Now, it's not to say, if you think about it in the long term, right, sometimes these things break down, right? And this is an important piece of this particular paper that was within here that I think is important to note as well, is like, where are you in the time horizon, right? Because there's going to be small things that happen within a single year, right? And there's going to be things that happen within the business cycle itself. And there's even a smaller cycle when people are day trading, swing trading, etc., that you need to kind of keep in track of as well. So some of these things you have to kind of realize, like when people are talking, what wavelength are they talking about some of these things? And is this a very macro? Is this very micro? Because that might impact a specific sector, that might impact the entirety of the market. So that might be talking about the entire business cycle. And I think what Chris is referring to, and correct me if I'm wrong here, Chris, because I think this is important for people to kind of understand, is we're talking about a conclusion of an entire business cycle. We've been very bullish since the second half of 2022, where we bottomed out a 30% decline, not recline. I wish I was reclining. 30% decline from January 2022 to December 2022. And that's when you and I really started to hit our stride, I think, and actually started working together a little bit. And we pretty much have ridden the markets very healthily since that point. And it's done really well for our portfolios. But like you stated, like, is this a time where you could potentially take that opportunity where things are starting, generally speaking, Sorry if I'm going on a tangent, and you know this because you study the markets, you study interest rates, you study all this. When they're cutting interest rates, it's generally not a good time. Generally they cut interest rates because there's some cracks in the environment. So they cut interest. You think about 2000. Why'd they cut interest rates? Cut interest rates because of .com. 2008. Why'd they cut interest rates? They cut interest rate because of the financial crisis. 2018. Why'd they cut interest rates? Because repo was wreaking havoc, and then eventually, they started pausing and actually started reducing, and everything was starting to get a credit crunch, and you were seeing some bad shit, and then obviously the pandemic happened, and we all know kind of what happened with that. So generally speaking, when interest rates are going in the opposite direction, it's out of a position of weakness, generally, not a position of strength. This isn't really the only time where we've cut, and it hasn't been for like an emergency purpose, but that I think remains to be seen. We might be in an early stage where, like we were in 2018, where things were getting hot and we needed to kind of take our foot off the gas. And anyway, back to you.
Yeah. So no, I mean, you have to, the one thing I'll tell you, you have to be very careful and look at every company as an individual company within the sector, because some will recover faster than others. So, like you just really have to dig down deep into the business model and see like, what are they doing? Like, so here's an example. If you look at this right here, Elevance is a great company, and they generate, good profitability. But the thing is, their operating profits have pretty much stayed flat for like a while now, right? Their margins have actually been, so their revenues have gone up. So you can see here, revenues are going up and to the right, but their margins have stayed right here. So the question is like, what's going on here? Like, why is your, let me just bring up the profit margin. Sorry. My bad. Profit margins. There you go. Gross profit, their operating margins. Yeah. So look at their operating margins. They've been flat, right? So 3.8%. So at one point, they might have had like some one-time events that caused their operating margins to climb up, and then they've just been kind of flat-ish. So the question is, would you want to buy into a company whose revenues are rising, but the margins are kind of flat? Like, what's going on here? And this is where you have to dig down into the company and say like, okay, like what's going on here? Like, what are they doing to kind of change this up? Are they, because the other insurance companies have better profit margins. And so, how can they start to reaccelerate this? And for Elevance, I like them because they're working on using some of the same kind of strategies that United used early in its like transformation from just a plain insurance company to also doing managed healthcare using something called value-based care. So essentially, they are in the process of kind of getting this to go in the other direction. It's not going to be crazy, 20% margins, but at the revenue level that these guys have, if they can improve their margins by 100, 200 basis points, is a huge move in terms of stock price for them. So yeah, so you have to, like I said, look at every company individually and then go from there, and treat every company separately. So let me see. Yeah, so I'm pretty bullish on Elevance. I think Elevance has got like a nice mean reversion play that we could probably like target.
I'm still kind of confused. I mean, do you just assume that the margins are going to increase? That's going to lead to a large increase in net operating income, and that's what's going to be the driver at the stock at the end of the day? I think that's what you're trying to refer to.
Yeah, so if you look at Elevance, they were guiding when the year started at about $34 per share in EPS. All right, this industry typically gets like I would say, well, Elevance in general has gotten usually like a 15 multiple on their EPS. So one of the things is right now, based on the current price, it's trading at at $340 with a $30 EPS guidance. You're looking at about 10-ish. So you still got this nice multiple what is it called? Retracement back to the mean again for these guys, right? So next year, their multiples should be expanding because they're going into some industries that are a little bit more high margin. So they have this one business line called, let me just actually bring it up. I could show you. So investor relations and slides. So Elevance has right here, the operating revenue is about 50 billion. So you can see the revenue has gone up from last year about 14%. Their adjusted diluted earnings went down a little bit. That's why like the stock is down, the entire industry is down. People kind of got out of it. They sold out of it. So the thing with these guys is that now they're in the process of improving their margins, and one of the ways that they're doing it is doing more healthcare services business using value-based care, and so this has a much higher margin. So this is a services business that has a higher margin that your traditional what is it called, traditional just straight line insurance. So as they're expanding their operating margins, their goal in the next couple of years to get to about 6.5 to 7, which I think that they can get to. And so they have these other businesses that can get them there. And then on the same time, if you look 2 years out, it's 2 years worth of share repurchases, 2 years of buying businesses that are value accretive to shareholders. So right now it's trading at a 10 PE, and over time it's going to be able to kind of move its way up. So if you look here, right now, these are the business lines. So 2024, the adjusted operating margin was about 4.2. Their target long term is get between 5.5 and 6.5. So if you take the revenue calculation that's going to be out 2 years, like projected, and then and give it that new operating margin, you're going to see significant improvement in EPS. And so as people
yeah,
see
to kind of give it maybe a more succinct thought, right? So as you were kind of stating, right, 6.5 to 7% on the just adjusted operating margin. If you're taking 5% today, that's an uplift of about 30 to 40%. So if you think about it, right, because you go from about 1.5 percentage points or 150 basis points to 200 basis points out of 5, that's 30 to 40%. And so coupling that with revenue growth, buybacks, etc. So I think that's what you're saying is basically that you can anticipate that, and that's for the entirety of the business, or that's just one sector of the business?
So that's the entirety of the business. Now so there's two things, right? This right here is what they're targeting, the 6.5 to 7 for the entire business. Insurance companies like this, they have two different sides. They have their insurances side, which is the health benefit side, and then they have Carelon, which is like the provider groups. You have like the pharmacy benefit manager that they have the specialty pharmacy division. That's all the other things. So insurance, from a regulatory standpoint, you're only allowed to have 15% margins, right? Most people, what they do is they contract their business to their own kind of pharmacy and stuff. So let's say you're an insurance company, you're Elevance, right? And you have a patient. Now, if your patient, is getting billed X amount of dollars for their healthcare insurance and everything else, which is,
can you just focus and let me know, like, so with respect to the amount of revenue that the company is generating from that particular part of the business, is it like 50%? Is it 40%?
Well,
I'm
that's
just trying to understand, right? Because like initially what I was thinking when you were going through it, it was like, that's like 100% of the revenue. Okay, you're gonna get 30 to 40% more ops margin. Like that's a big deal, right? You're talking about $18 billion of revenue on a quarterly basis. Like you're talking about a large increase of like ops income, right? But if you're talking about a smaller subset, then that's what I'm trying to understand.
Well, see, that's the thing. If you look at their insurance business, their top line insurance business, it's growing right here at like, this is their what is it? Yeah, this is their Anthem and WellPoint business. So not this one. Let me see. 1 second. Okay. So this right here, the health benefit side is growing at 11, so about 12%, right? And if you look at the operating margin, it was last year at 5.8, now it's 3.8. So they're working on getting this back to like 5.8, but that's not the growth driver, right? The growth driver that we really want to look at is this right here, their services business. Look at that services business revenue growth, 35%, and the margin for that is about they took a little bit of a hit from 5.6 to 5.2. So this is a much more higher profit margin business that they have. And that's growing at double digits, like almost 3 times. So what happens is your lower margin business becomes less impactful on your overall earnings, and your services business becomes more impactful. So that's why your margin improves dramatically. Because imagine right now, 75% of your business was coming from insurance and only 25% of the business is coming from your services side, with the services side having higher margins. Imagine in 2 years, your services side business grows 30, 40%, right? And it's able to maintain that margin. Now, what happens is your overall margin for the entire business starts to improve. Is that making sense?
No, I mean, that's the whole reason why, and correct me if I'm wrong here. I mean, that's the whole reason why Apple's revenue has actually been able to kind of maintain and actually potentially kind of retrace a little bit, and they've actually been able to grow operating income because their services business is such high margin comparatively to their hardware. And so that's why even though they're, they're not selling like 40%, 50% more iPhones in a year. Well, multiple things are happening, right? They have multiple expansion, and they're obviously getting a huge premium for the stock price, but also they are growing EPS through buybacks, etc. as well. But I think they are obviously focusing on the revenue in the services area, which obviously is a huge impact. So it kind of aligns with what you're saying with respect to focusing on where you have, or trying to grow where you have higher margins. I mean, that's what every business tries to do, or should try to do.
Now, what's interesting is, normally speaking, this wouldn't be as interesting to me, because it's like, it's a managed healthcare business. It's like going to go at that single-digit growth rate. It's like, but when you have this crazy sell-off in the entire sector, and you're seeing companies that are down 50% over something that's a short-term kind of thing in the current market, that leads me to say, like, wait a second, no, there's like value opportunity here. And then on top of it, when you consider that the market's a little bit frothy, you kind of want to be in areas that are value, So it's almost like you're getting, and this is actually really interesting, because you're getting a really strong non-recessionary defensive business at a cheap price, which doesn't happen very often. And it happened at the quote unquote at the perfect time, because right now everything else is like 30 PE plus. These things are like 10 PE, on a forward basis. Some of them are even lower. So it's like I said, it's a great place you want to just hide out a little bit. And as the entire sector recovers, there's ability to generate a nice strong return. So you can see here at Elevance, like last year in 2024, it was around $500 a share. Now it's about $340, and it had an all-time low in August of about what is that thing called? Right here, like $275. So there's still long ways to go for them to get to where they were before. So over time, as they improve their margins, improve their business operations, it'll slowly, gradually get up here again. So
I mean, what was their PE trading like back then? Like, is that reason why maybe the price was getting out of control?
No. This industry, the PEs are usually pretty stable. I mean, it's a very predictable business. It's not. Let me bring it up 1 second. Sorry. KPIs, and where would it be? Sorry. Forward PE right here. Okay, so let me just hide operating margin and just do forward PE right here. Because of this thing, it looks a little off, but usually it's within this range. of about 12, and if it does well, like 16 PE.
Okay, so it's not like it ran to 25x or something like
No,
that.
no. It's like I said, it's relative. It's a much more predictable business than a lot of other things. So let me see if I can just. There you go. Instead of doing annual, just do like last month trailing. So there you go. So you're essentially buying something that traditionally has a P, like trades at a PE around here, around 13 to 15. You're getting it at 11 right now, right? And that's on a
Mhm.
forward basis. So, if you go 2 years out, like, and you just try to calculate, like, okay, what are the CAGR on the earnings going to be? It's probably going to be close to like $37, right? So 37. Let me just do the quick dirty calculator. So let's say 37 times 15. Sorry, 37 times 15. You're looking at $555 a share, right? If you want to be a little bit more conservative, you do 37 times about 13. You're like at 481. So even from today's price, so that's like $100 of additional thing. And this thing pays a dividend. If you want to run an option strategy, there's some
Yeah, I was
option
about to say.
strategies that run.
So, yeah, I mean, is that something you're going to disclose, or is that something that you're going to keep and you're still working through?
I'm still working through it. Like
Yeah.
one of the things that we have to look at is how this Congress situation works out, because some portion of their earnings actually comes from ACA
Medicare,
and Medicaid, not so much
Medicaid.
Medicare. So the impact on from those cuts could theoretically, readjust things. But let me just bring
Hmm.
this up. So each one of these companies has different levels of exposure. Let me just bring it up. Sorry. Blah 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 blah. Ugh, this entire sector, PBMs.
I don't know. It's tough for me. From a first glance perspective, like you're walking through this versus walking through Novo, and I prefer Novo over this personally.
I mean,
And maybe that's just bias because I
yeah,
understand the business a little bit better. Insurance kind of scares me to an extent. If it was insurance like Chubb XL or something like that, then I'd be like,
yeah,
I feel like a little bit more comfortable with that. But health insurance, and that's part of the reason why I got spooked out of Oscar too, right? Like,
yeah.
anyway.
So right here, so you can see that each company has different exposures to different parts of the insurance marketplace. So for Elevance has more Medicaid exposure right here, Medicaid and ACA exposure, than something like the Cigna group. And so Cigna hasn't taken nearly the amount of hit that Elevance has. So if the cuts do materialize in ACA and Medicaid, it might slow them down. It's definitely not the same level of impact as, let's say, Centene and Molina. Centene and Molina, they're very dependent on Medicaid and ACA. So if anything happens, they're gonna feel it. These guys are not gonna feel it as much. United is gonna feel it, but not necessarily that much either. You know.
Mm.
So that's one of the things you have to look at. Now United has a whole host of other challenges that they're going to have to deal with, but one of the things I told you with Elevance, if you look at their revenue that they have right now, let me just go. Sorry guys, I have to scroll through everything. Okay, so you see Elevance right here, 86% of their revenue comes from the insurance side of the business. Only 14% comes from non-insurance. So as they expand this non-insurance part, you see how United almost 25% is coming from non-insurance, but that non-insurance is almost 49% of that operating earnings. That's the same thing that's going to happen here at Elevance, where 14% of their revenue is generating 28% of their operating earnings. So if this doubles to like 14, this should actually become bigger part of
Mhm.
the mix. And because it becomes a bigger part of the mix and it's more profitable segment, it ends up being value accretive to shareholders.
Mm.
Right? So usually you want to kind of have this is just how the market is kind of trending towards it right now. But Elevance has this opportunity in their non-insurance side that could be really big. You know.
Interesting.
Yeah.
Am I on mute?
Yeah, like if you look at something like
No.
Humana, so people are like, oh, well, what about Humana? And the thing is, Humana doesn't have exposure right here. Humana has very little exposure to Medicaid at the bottom. Most of their what is that thing called? Most of their revenue comes from TRICARE, which is, you know, federal employees like the military and stuff, and then another chunk comes from Medicare. So exposure in terms of ACA and Medicaid is very low, but they've been sold off just the same, right? Look at that. So how does that make sense? On one hand, you're saying, well, you know what, we're going to be making some challenges to Medicaid, and I understand that, and that's why companies like CNC, which has a huge Medicaid population, especially actually Molina's population, like Medicaid population. Look at this. Since the Trump administration came and they did the big beautiful bill and everything, this thing went from 297 to like 155. It's starting to recover slowly as like the legislation that's coming out is a little bit more mild compared to what the market had originally thought. So this is like could recover a little bit, but for that reason, I actually like companies like Humana and Elevance a little bit more. So you have to really dig down deep into every managed healthcare organization and figure out like which one is gonna, you know, recover and at what pace are they going to recover. But if you just look at the entire sector is sold off.
Sounds like it's all going to zero.
It all goes to zero.
Yeah. Interesting. Well, appreciate you giving that and shedding that light. Health insurance is an interesting one, and I appreciate you kind of shedding light with respect to like all the different nuances, right? Because there's specific like you showed commercial, there's the ACA, there's Medicaid, there's so many different avenues to it. One that I was thinking about, and I'm kind of curious on your thoughts about this as well, because you're an ASTS guy, you have some money in that, and they've obviously announced some news, and I don't know if you've been following that or not, and you want to kind of touch on that, but there's another company that has taken a huge tumble as of late in the space sector, and I'm not saying I'm buying right now. I did sell puts. I will disclose that. But I think that I'm keeping an eye. And if it drops much further, I don't think it's as easy or how do I say this? Well, it's different, right? So obviously, I think everyone knows, like for me, in retrospect, Rocket Lab at $2 billion market cap after launching 17 rockets, like that was kind of like, oh, these guys know what they're doing. They probably have a good shot of being successful, you know. Yes. So we have a comparable company that has actually landed on the moon that is now trading at a 3.8 billion market cap. Let me see.
Is that the Lunar Machines one?
So the $3.9 billion market cap. So they went public. Let me just share my screen here. Where do they go? Here we go. Window, entire screen. Here we go. They went public about a month and a half ago in early August, and it's Firefly. So now I'm not a huge Firefly bull, and yes, they've had spotty success. And a lot of what their success has been with respect to landing on the moon could be attributed to Rocket Lab itself. But if you think about it comparatively, if you try to understand long-term, where is this company going to be? You know, is it going to be a 10 billion, 20 billion? I don't know. Right. And that's kind of where I'm sitting here. Like, at what point is the right time to start potentially trickling? And if it's going to, like, I'm just trying to put this on people's radar, right? Because sometimes these things happen very quickly, right? The stock was just at $45. You can see this on the chart here, right? Like the stock was literally at $45 less than a week ago. And here we are, the valuation getting cut by 40% pretty much over the last week. And so if it continues and right sizes itself because of the earnings, obviously it's part of the reason why. They also just had an explosion on one of the rockets. So sometimes when there's blood in the streets, it gives you opportunities. Now, is it going to drop to $2 billion market cap? I don't know. But if it gets to a $2 billion market cap, I actually don't think this is a stupid idea to potentially pick some up. Now, there are obviously some hair on it. Is it going to be as obvious as Rocket Lab? It's 50-50, right? Like Rocket Lab at the time, they'd launched 17 vehicles in the air. These guys have launched like 7, and not all of them have been successful. Very sporadic and spotty record with respect to that. But they landed on the moon, you know? So if you think about it, it's like, well, shit, you know, you could, how successful is that? And I think they have 4 more missions or 3 more missions associated with that. So you start to think, it's like, okay, well, what's the long-term opportunity associated with this, right? And you know me, like I always try to think 10, 15 years down the road. It's like, well, you're not buying it for today, or at least I'm not buying it for today. I'm buying it for, you know, what would it be? Would it be a $50 billion company by 2035, 2040? I don't know. And so it gets me thinking, it's like, I don't really know much about this company. You know, what do they have like in terms of information that I can kind of poke at? And so I was like, well, let me just see, like, are they trying to have the same aspirations as a Rocket Lab? Are they trying to have a medium launch vehicle? Are they trying to do like deep space sort of stuff? Like where are we on the spectrum, right? Because if you're just trying to focus on like single small launch and you're not trying to expand into communications, like what ASTS is doing with, like, you know what I mean? Like you start to try to understand what TAM are you looking at, you know, what revenue, what margins, etc. Like everything that we've been talking about all night. So I was like, okay, well, let me just take a step back. They dropped below $4 billion market cap, like starting to get exciting. What are they doing? So they have the small launch alpha vehicle, which is about 3 times the size actually of Electron. So if you think about it, even though it's a small launch vehicle, it's still 1,000 kilograms versus 320 kilograms is Electron. So it can have a little bit more payload capacity. So that's something to think about. Another thing I didn't even know, which, you know, stupid of me, they have the Eclipse vehicle, which is supposed to be pretty comparable, if not slightly larger than the Neutron vehicle. And they're hoping that it's also going to be, their first stage is also going to be reusable. So that's interesting. I feel like they're obviously way behind comparatively to Rocket Lab. Obviously, because Rocket Lab has obviously launched 72 rockets at this point. These guys have, I think, a lot more testing done on their stage 1, stage 2 for their second vehicle. These guys say by end of 26 they will have something. I don't know if that means it's going to be launched or what, but I was like, interesting. Didn't even know they had a medium launch vehicle. They also have some satellites called Elytra, stuff like that. So I was like sitting there, I'm like, this is starting to get a little bit more interesting than what I originally thought, right? I just thought Firefly might be, you know, somewhat government contracts, the 1,000 kilogram rocket. And you start to think about it a little bit more. It's like, well, where does the buck stop? So I'm interested. I think I'd be willing to gamble if it. So I wrote $20 puts. Because it gets to $20. I think there's 146 million shares outstanding. That gets to a $3 billion market cap, and I'm willing to start a position at $3 billion. I would say, and I would probably start to add size at $2 billion, and I would probably load the boat at not load the boat, but probably get a risky enough position at $1.5 billion market cap. So that would probably make it I don't know, $9 or $10 stock at that point.
So they don't have any. So they have barely any revenues, which is fine. Totally understand. This is a brand new company. You're not gonna have revenues like that.
Yeah.
But here's the thing: with their cash flows, how fast are they burning through their cash?
They're burning quick, and that's part of it as well, right? Like that's tough. That's part of the problem, right? And Rocket Lab was in that scenario as well, and so that's part of where they're not in the same space as Rocket Lab was, right? Rocket Lab at least was starting to get a cadence when they had 17 launches, and yes, they were coming from a position at that point of, yes, they were still burning cash, but they had cadence and growing. these guys have a very intermittent launch cadence. And so to me, it's kind of like, how can you help start to understand at what point you're going to get to some sort of profitability piece? So anyway, it's interesting.
This is not fun to look at, though. Just be careful of this. I've gotten screwed over in the past because of this. So let me just show you right here. So what they've done is the net issuances that they've have basically come from, this is the cash and cash equivalents. Let me just put this away. So they've got 123 million in cash equivalents, but their net issuances have basically been long-term debt and preferred equity. This is revenue. Are there like some kind of shareholders that
they just went public, so I don't know how much you could trust a lot of this data.
Yeah. I'd have to look at the capital stack. I'm not a fan when companies take on debt with preferred equity, because a lot of preferred equity, they sit above common shareholders. So what they'll do is when things go good, they'll just convert to common shares, and the entire time these guys are milking the cash flows, because they're still getting paid a nice sum of money, and they're not taking any risk. So if they keep financing things through preferred equity and long-term debt, I wonder if they'd be like, I don't know. It's too early to
it's early, right? And then this is, like
early.
I said, I think it's a lot. It's in an interesting boat because they've landed on the moon, but they don't have nearly the cadence Rocket Lab did. So I think it's still way more speculative than Rocket Lab. Rocket Lab, I felt like, was a no-brainer. They had launched 17 times. If they could figure out the financing, which now they have, like, they're obviously on a good trajectory, and within the next 12 months, Rocket Lab will actually be EBITDA break even, if not actually cash flow positive, which is actually really interesting. I don't know if you've ever looked at that. I would love to get your thoughts on the looks of it. And it looks scary because of the revenue growth. The operating expense growth because of the R&D. But if you remove R&D and you only look specifically at OPEX, income? Not the R&D expense, then it actually looks pretty good. But obviously, it looks like garbage because of the R&D expense, because of what's going on with Neutron.
They're transitioning from heavy R&D to now actually generating cash flows from deploying satellites. So, and also from that other segment, the satellite manufacturing business, right, and design business. So those things will help. They're not going to have nearly as much cash burn. Right now, their cash pile is sitting at what? Let's see. Yeah, they've got plenty of cash. Yeah, they got plenty of cash. So they could basically chill out, relax, and get to the point where profitability gets there. So I think that's the bet that a lot of market participants are probably making, including yourself, because now the cadence of Neutron launches, the cadence of Electron launches has gone up significantly. I think when is Neutron supposed to actually go into like full scale production and launches?
Sorry, just double check I wasn't muted. Full scale. I mean, their hope is still that they would get it off by the end of the year for their first inaugural launch. It obviously is a rocket program, so I wouldn't be surprised if it ends up being pushed. It already has been pushed a year, right? Like when they announced it in March 2021, it was supposed to be December 2024, and here we are, 9 months later. So, but in terms of like full scale, do you mean like on a regular cadence?
Yeah.
What do you mean? So they're thinking 3 launches, probably a year afterwards, and then 5 launches in its third year. So 1, 3, 5 is their kind of thought process. First year, 1 launch. Second year, 3 launches. Third year, 5 launches.
Yeah.
So, but yeah, but this is interesting. Let me pull this up. This is probably will hopefully make people a little bit more bullish if they are not at the moment.
So
So
you ran a model. You ran a model on it.
yeah, well, I mean, this is just legit earnings reports, right? So the blue is revenue. So you can see it's obviously going up and to the right. Green is gross profit. So that's just, showing that cost of goods sold, being subtracted out. And then red is obviously the operating expenditures, inclusive of R&D. And so that obviously has been going up on a quarterly basis. But the nice thing about this, if I scroll over here to the right and you start to separate them, the R&D is actually this. So obviously the blue is the total OPEX, which obviously is going up and up and up. But if you look at the actual R&D, that's what's really been driving up most expansively over the past, year and a half, 18 years. Year and a half, 18 months. This SG&A, comparatively how large it's grown, is actually not too awful in terms of total growth. So if they're able to reduce this and actually shrink this R&D expense, which I don't know how much they can shrink it by. Is it 50%? Is it 70%? I don't know. And that's part of the reason that I'm kind of like, But if you look at the ops cash flow, it's really not bad. And over the past 2 years, they've almost been ops cash positive 3 times. Which I don't think people are fully comprehending, right?
Yeah.
So they were almost ops cost positive back in the second quarter of 23. They were within $2 to $3 million of ops cash positive in the first quarter of 24, and they were within $3 million of ops cash positive at the end of 4Q24. And I think that's why people are like, oh shit, these guys are actually close. And if you think about it, this is while they're spending a pretty good amount of money on a Neutron rocket that is going to cost them $300-400 million to put on the pad. And so all the while they're growing a space systems business. They're getting ready to launch their own constellations, which is hopefully going to compete with, I don't know, a bunch of other stuff out there that, potentially with other communications opportunities. Who knows what the hell exactly you're going to do? They haven't really announced it fully yet. But if you think about it, all you need is this R&D expense to kind of go the other way, this OPEX to go the other way, and Bob's your uncle. You're actually starting to generate ops cash. You don't really have to worry about cash flow anymore, if that makes sense. So it's going to be an interesting next 12 months. You're going to have this medium launch vehicle running, and you're going to start to see them actually hit, they've been close 3 times. You're actually going to see them hit kind of this neutral point. And then I'm curious to see, if this trajectory continues, their gross margins, I don't know if I have a gross margin chart on here, but they've gone pretty much over the last year. I should build it because it's been pretty impressive, from like the low 20% gross margins to now the mid 30% gross margins and growing. So I'm like, shit, well, I didn't think we were going to get to the mid 30% this quickly. Where do the gross margins end? Do they end at low 40s? Do they continue to climb? And obviously we know if you put satellites into space, like ASTS is a prime example, the gross margins that you would expect for ASTS are in like the 80s or 90s, right? Because as soon as you launch it, like you're on a CapEx holiday at that point. Like all your CapEx is up front and you're just realizing this tail of revenue for 5 to 7 years when things are in orbit. So I'm kind of sitting here like, shit, like have I been thinking about really the potential long-term value of this company slightly wrong? So
yeah, it's interesting.
All right, went on a little space tangent there, but I thought it was interesting, and I never really thought about Firefly as an investment, but them coming down in valuation by almost 50% since their IPO, it always makes you think.
Yeah, just the space industry is starting to get traction. That's why ASTS has been doing really well too, because they're finally starting to launch some of their newer Bluebirds into the atmosphere, and so eventually the revenue is going to start trickling in, and a lot of people are, like the space mob is basically projecting out this rosy future, and so they're willing to pay a good amount of premium today, and the market's loving it. So yeah.
Were you ever a PayPal guy?
Yes and no. I had PayPal as a very short-term trade until
I thought you did.
When the new guy Alex Chris came on. He was like, "Oh, I'm gonna do X, Y, and Z. I took a very short-term approach, and I was like, okay, new CEO, he's got a good pedigree. Let's kind of see what he does. And PayPal never really like went anywhere, but I think that's about to change, to be honest with you.
I think so. Because
Yeah,
of the share buybacks, or what? Like what is it?
yeah, it's a
And
combination.
I'm hopeful, by the way, because I love Roy, and Roy's talked my ear off about it, and in a good way, right? I get lunch with Roy as much as I can. And Chris Patel, that's pretty funny.
Yeah.
And so I see the opportunity, right? And they're not a not profitable company, right? And so it's hard when you see companies like this that are kind of floundering, and they're not growing, but they're not shrinking. I don't know.
Where we are in the cycle, people value growth more than they value value, right? So you have to remember, when someone looks at, can you share my screen real quick? Let me just share.
You got to share for me to share it. Just kidding.
True, sir. There you go. So if you look at their revenue, growth, it's literally like bottomed out. It's like 4% right now. So people look at this and say, oh, this is a dead business. And that's not true. This business is not dead, because if you look at on a per earnings basis,
I feel like we did talk about this the other day.
Yeah. So you can see that their earnings are growing. So this is transitioning from a growth company to a value company. Now, the thing is, in times like this where people highly value growth, people are not going to give this thing a decent multiple, and some of the multiples are not deserved, right? Like this feels more like a freaking bank than it feels like a high flying tech startup, So if you look on a forward basis, let me just bring this up. Sorry, forward PE. People are gonna look at this and say, "Hey, wait a second! Like, let me just hide
12.
Yeah. So right there, let me just hide some of these other things. Okay, now I can just do forward PE. Okay, so there you go. So now what happens is they went from a 60 PE on a forward basis to now all the way to 12, which is what a typical bank does, right? So a typical bank has very similar PE ratios, which is fine. Now the thing is, at the pace that they're buying back their shares, though, their EPS is going absolutely insane. Like their EPS is going much higher. So on a per share basis, the impact from the buybacks is starting to become tangibly better. So you can see here, let me just separate this toggle access. So that EPS is going in the right direction. So if they can keep growing their EPS at the CAGR that is growing at a 17% CAGR, you're talking about a company that's going to do, let's say they're able to maintain a 15% CAGR on their earnings, right? And just do like a 5-year out scenario. And we could just do that in Excel really quickly.
So I mean,
yeah,
I'll let you finish.
Sorry, go ahead.
No, I'll let you finish this piece.
So like, let's say this year, 2025, you got a PE of about 4.7. 2026. And I'll blow this up for everyone to see. Like, okay, so this is their earnings. They're CAGRing at about 15%. So 1.15. 1.15. And you do, like, say, a 12 multiple, right? So that means that if you get the same multiple in 2026, it's going to be worth $64. And by 2030, it's going to be like $113. So it's almost a double in 5 years, right? Because what they're essentially doing is, So on a per share basis, you tell me, is this something that you would want in 5 years, a double with a pretty strong business?
If you can kind of guarantee that, a double in 5 years. So what is that? I'm not good with math. What's the rule of 72? So you would do, how would you rule of 72 that? Trying to remember.
Try to hold on 1 second.
No, that's not how you do it. So 5 years time you do a double. So I would assume it's like a 16% compound annual growth rate.
Yeah, but dude, if the S&P is yielding you what, like 7% year over year growth if you look at the S&P historically, it gives you a return of about 7%. This is doubling that return.
Well, that's yeah, you didn't let me finish. I mean, that's my thought process. If you're looking for something that's like stable and you can feel like you're guaranteed, I don't think it's horrible.
Yeah.
And like you stated, I think that is just with buybacks. That's not really necessarily growing the PE at all. That's not necessarily so.
See, that's the other thing.
I've always thought that was the play, right?
Yeah. So let's say they're able to kind of grow their PEs also, then it could be much higher. You know, I wouldn't go to, I'd probably leave it at 15 and probably do this at a slower cadence, about like 12.5, maybe like 13, 14 over here and 15. So, you know.
But then you're looking at, 1.5x.
Yeah.
And like 125, 150, and that's closer to 20% annualized. And 20% annualized is great.
Yeah. Yeah. I mean, that's the thing with these businesses that like are eating their own tail. It's great if you're looking long term. You have to really think far out. Now, here's the thing. If you had bought this 2 years ago, you would have been waiting for the impacts from the buybacks to really take hold, right? So you can see here, now they're finally starting to become value accretive.
But can I run a scenario, if you don't mind?
By all means.
So now take that final number and let's just say the PE doesn't actually expand and it goes to 8.
Mm-hmm. Well, that's the thing. Then it's super undervalued because that entire sector trades at a 10 to 12 multiple.
But what if it's like, I'm just saying, like it is now, like you would anticipate that it wouldn't be trading at a 12. You'd anticipate to be trading at north of 15, maybe even closer to 20. Well, but it is trading at a 12.
Well, that's because of their EPS growth. Their EPS growth, if you can show that you can grow that EPS at that CAGR pace for a longer period of time, then investors will naturally say, oh, wait a second, there's something here. Now, in my opinion, they need to at least stabilize their revenue decline.
But what I'm saying is, though, Chris, is like, yeah, we're talking about how right now it's a 14, 15% annualized. That's great. But if it actually ends up being, and it doesn't actually grow and stay flat at a 12x multiple, and it's actually 8, like, yeah, you can be like, oh, it's super long. But then you start growing. It's like, okay, well, if it's at 8, how long do I have to wait for it to go from 8 to 12, right? That could be tomorrow. Like, it could be revalued, right? But at the same time, it's like, what I'm just asking you to do is like, there is a downside, right? Which is it does go to 8. And my question is if you were to put an 8 multiple on it, what does that look like? And what's that return?
Oh, my bad. I should have.
Is that closer to, I didn't realize you closed it.
No, it's fine.
No,
it's, damn it. Where is it? This is my model for Ethereum.
I thought you had open. That's my fault.
No, my bad. See, the thing is, if it drops down, let's say the PE goes to 8, which I don't think it can because it is a very profitable business, generates significant operating income, then the share buybacks become even more meaningful. And you would get literally like 2 years out, you would benefit even more.
So if I remember correctly, it was like at a 15x multiple, it's like $140 a share or something like that.
Mm-hmm. Yeah.
So 140 divided by, whoa, why did that happen? 140. I'm doing mental math. I'm not sharing my screen. So that would be like 9.3 EPS. So $9.50, let's just say. Multiply that by the 8. That's still $75 a share. So you wouldn't have grown at all if it drops to $8. That's basically what I'm saying. And so it's like,
I would be hard pressed to find.
I would have been hard pressed to say it would go to 12.
I thought it could get to 10 because that's what a lot of the banks are. If you look at let's say TFC, right? Truist's PE is come on. Like this is one of the biggest regional banks in the United States.
But what you are saying, and I think this is valuable to hear, is like if you're willing to take that risk, I don't think you'll lose money.
Yeah. So
even at the buyback, right? Even at the buyback, you know, at the rate that they're buying, if it does go to an 8 PE, you're still going to grow from here.
Yeah, I mean, look at the other banks that are out there. TFC has 11, Bank of America has 13, Wells Fargo is 13.8, Citi is 12, PNC is. So this is the range that most banks are trading at. You know, so it's not like, oh my God, super expensive. Oh my God, super cheap. You know, it's just trading at the current like standard level that these guys are. You know.
Yeah. What was it to say? Do you have any other? Somebody asked. Do you have any other fintechs that you're interested in? Sorry, I'm just ordering. I haven't eaten dinner, and I am gassed. I'm running on fumes.
Hey, shout out to the producer wife. Yo, babe, the coffee today is on point. I don't know what you did different.
The producer wife is always on point,
bro. That's why she came in. She was like, "Oh, do you want strong or do you want weak coffee?" I was like, "Yeah, you know, I need to be."
I thought she was gonna find me a producer wife. She knows I'm into those Daisy women, and she's slacking. Producer wife needs to work. I got one of the last few good ones. I got one of the last few good ones. All right. The rest of these Indian chicks, they are all like ABCD, man. ABCD.
They all grew up around here. They learned from all the white women with their entitlements. Sorry, white women. I don't mean to offend people, but dude, like a lot of these modern girls, bro, they want everything. They want. She's still like the logic behind my wife. I still remember my dad told me, said, look, just look at the mom. If the mom is good, the daughter is going to be good too. And so when I met her mom, I love my mother-in-law. Okay. Like most guys, they hate their mother-in-laws. Me and my mother-in-law, we're like this, son. We're like this. So if I ever have to, I put drugs in it. Okay. if I ever any issues, I don't even need to talk to her. I just go to the manufacturer.
You're like, I need a recall. What is going on? Yeah, I love that. Yeah. But yes, October 2nd, 2025, we have turned into a red pill podcast. No, I'm just kidding.
This is the Fresh and Fit podcast.
Yeah, welcome to Fresh and Fit. No, man, they do way better job than I do. They would tell me I need to hit the gym and stop being a pussy. Interesting. Yeah. So any other fintech? Sorry, I know you were talking about. We got distracted by what did she do, by the way? What did she do to that coffee?
I don't know. I've just really
don't release your secrets, girl. You got to keep it on the DL.
Mm-hmm.
Next thing you know, people be putting that stuff in a bottle and lose your secrets.
I think she might have gone a little bit extra on the sweet cream. So we get Colombe coffee. She puts a little bit of milk and a little bit of sweet cream. I think the sweet cream did it. Yeah. So it's is it cold brew, honey? Is it the thing that comes out? I don't know. I'm not the coffee guy. I just know that you just.
Do they have so I've always, when I was doing Costco when I moved back from Trinidad, they had the 4-packs of the Colombe. But do they have like a bigger thing now, or is it still just the single cans?
No, we just get the single, like what do you call it? Like the big boy, yeah. And you just put a little bit, and then you put the milk and everything.
Okay, I'll have to look for them in the store.
Colombe. I don't do Bustelo, man. I've drank Bustelo once in a while, bro. I'm like awake for the next 2 days.
Yeah, it's just like straight gasoline.
When I was still working at the hospital, man, that's when you would get a Bustelo, bro. Bustelo was awesome. Like Bustelo is like Red Bull on crack. I know.
Yeah.
So,
I got my sister and my sisters, they got me a K-Cup machine just because like they know I would always go out to drive, and they're like, oh, like Matt mentioned, like, oh, he spends a lot on coffee, etc. So let's buy him a K-Cup machine. So they bought me a K-Cup machine. And I saw on like X or TikTok or something, the guy that was like making jokes about Bustelo. And I was like, I wonder if they have Bustelo K-Cups. And so I never had Bustelo before, like 6 months ago. And I made it, and then I was like, yep. I was like, I'll be up for 6 days. Like, this is some wild shit. But
Yeah,
anyway.
man. No, it's just I think we're getting to that point at the end of the year that we just have to keep our head on a swivel. I think we're going to get a nice rally into this year. I don't think there's any sort of issues, especially with the rate cuts coming. Bro, it's going to be great. That's the other thing too with the insurance companies. Like, a lot of them might actually benefit from AOCI loss drawdown. So I'll give you an example. So if you look at the regional banks, they have heavy exposure to something called AOCI losses. Now, let me explain how that works. So let's just show Truist.
The credit loss provisions, or
phantom losses, basically. So, okay. I'm going to paint a very quick scenario for all of you guys. Imagine right now you're a bank and you lent out money to somebody for the next 5 years at 3%. Okay. So now, you're getting a nice 3%. At the time, the interest rates were 0. So you're making a $300 spread, right? Great. Everyone's happy. You're getting 3%. Now the Federal Reserve says, oh, inflation is too high. We're going to raise interest rates to, oh, thanks, honey. This is the one, if anyone's wondering. Colombe.
She's giving her secrets. Oh, that I haven't seen that.
Yeah. And then for the sweet cream, it's this right here, Chobani, which is really good. Is this just sugar, honey? Yeah. And
why is she whispering?
for the milk, I don't know if you guys have tried Fairlife, but Fairlife is like lactose free. So thanks, honey. That's nice of you.
Wait, Fairlife's lactose free?
Yeah, and it's 50% protein.
Or is that one lactose free?
No, that's 2%. Hold on 1 second. 260 milligrams per serving.
It's only half of yours.
Oh my god! Damn, no wonder. Okay, yeah. For Fairlife, it's 50% less sugar.
Sponsored by Fairlife. We're sponsored by Fairlife, guys. I have my.
The funny thing is, Fairlife, I think, is owned by Coca-Cola.
They are actually. I think it is. Yeah.
Yeah. Thanks, honey. Yeah. Okay, so AOCI loss. So
mine says contains milk, so I'm fucking confused.
Does it? Well, this one is lactose free. This is 2%. I don't know if it's something different.
I don't know, but this stuff tastes like pure chocolate milk.
I've got that too.
Those are so good.
Yeah, my wife will make like smoothies for me with that. Yeah. So it's like
this is what I take my morning meds. I take with this.
Nice.
They last me like 4 days because like I don't drink the whole thing because like I just normally drink it to take my meds and then I go to the office and I don't eat until like I eat a small snack for lunch and then I haven't eaten since then. So anyway,
yeah,
I heard her voice.
So with AOCI, so imagine right now you issued, loans to somebody for 3%, and now the Fed raises interest rates, and now the current market for loans is like 5%, right? So you basically are still getting paid from who you lent the money to, but you're technically absorbing a phantom loss, right? You're basically getting something called an AOCI loss. So you have to acknowledge that. So you have to say, well, I lent someone $100 at 3%. Now, if I lent that same $100 to somebody else, I would get 5%, which means that the loan that I made at 3% is worth less. So that sits on your balance sheet. And the thing is, it acts like a negative driver on your book value, right? And so banks have to maintain a certain amount of liquidity. And so those AOCI losses, if they get included in your tier 1 ratios, that means that now you look unhealthier than you normally are. Now, on the other hand, when interest rates go down, right? So, before you were lending money to someone at 5%, if the Federal Reserve says, okay, we're going to cut interest rates by 3%, now all of a sudden that money that you lent out at 3% is not technically paper losses anymore. And so now your tier 1 capital ratio improves. And as your tier 1 capital ratio improves, you're allowed to lend more money out. and as long as as you're lending more money out, you make more profit, right? So let me see if they actually include AOCI losses on here. Actually, let me just show everyone AOCI losses, regional banks. Damn it. And everything is behind a paywall these days. Okay, so you see right here, accumulated comprehensive income at the largest banks. So you can see here in 2021, it was only about negative 34 billion. And because the Federal Reserve started to raise interest rates, everyone started to get these giant AOCI losses. And these have been sitting on people's balance sheets. So these are the major ones. So like Truist that we were just looking at right here, it has about balance. Well, this is from 2024, remember, so about three quarters ago. They've done some things to kind of improve by selling some of their insurance businesses or whatever, but essentially these losses are sitting on the balance sheet. So as interest rates come down, these losses all go away. So right here, if you look at the assets, the total assets that they have, like so Truist has 520 billion in assets. Their AOCI losses right here balance is about 8 billion, you know, and so it should dramatically improve. So,
or if their bonds roll off, right? So it's one of the two.
Yeah. So like a good example is Bank of America. They got caught flat-footed because they bought a lot of treasuries when treasuries were yielding 2%, 3%. So
that's what happened to SVB, right?
Yeah. So a lot of what happened with SVB and FRC is that they lent out money at really cheap rates, and then all of a sudden the cost of capital ended up becoming more expensive for them, and so they had a bank run. And the thing is, a lot of the stuff that they have is illiquid. So imagine you lent out money at 3% to somebody for the next 10 years. You can't just say, "Let me get my money back," because interest rates are higher. You have that fixed contract. The challenge is, let's say you as a FRC member or a SVB depositor, you go in and you say, "I want my money back." They have to basically sell that loan to somebody at a huge discount to give you your money back. Yeah. Right. So that's what happened to SVB and FRC, basically, where they got hit with so many what is it called? Not redemption, like withdrawal requests, that they were insolvent, because if they had sold those treasuries to somebody else, they would have had to take a 50% haircut. And now their entire assets, their equity would have just been wiped out. So that's why JP Morgan, because JP Morgan has all this additional cash that's sitting on their balance sheet, they said, "We'll just buy this company out for basically peanuts." And now they get all of these treasuries sitting on their balance sheet. And if anyone ever comes to, JP Morgan and says, "Hey, I need money," JP Morgan's got some of the best financials out there. So JP Morgan can give them money. So JP Morgan did really well on the whole thing. They've got $4 trillion in assets. Insane, right? Freaking JP Morgan. And look at that. At the time, it was,
And Wells got screwed. I mean, in 2018, they've had to keep their 1.9. They don't have to anymore. So I'm actually kind of curious. But I wonder if they have a graphic for that, because they had to keep their assets at 1.95 or something like that for, asset limit over time. So it was insane. Okay, so it was from 2018 to 2025. They had to keep their assets limited to 1.95 to 2 trillion. Comparatively to like JP Morgan, who was able to continue to grow it from 2 to 3 to 4, like just because of everything that they did. Basically, they got their hands slapped for making fake accounts and stuff like that to be able to help increase like incentives, and people were paying themselves and patting themselves on the back. But I'd be curious to see actually like how it flatlined, because they ended up selling off, because it goes back to what you were talking about earlier with Elevance. It was like they were looking at all their businesses, and they were saying, well, shit, if this is only margin of, let's say 5%, let's sell that so that we can get back to that 1.95 trillion and lend it at 10% or make a 10% on our money versus the 5% on our money. So they sold off a lot of different things. They sold off auto. They sold off a lot of profitable businesses that unfortunately they probably could have kept on to, but they had to get rid of because they were so limited.
So
up until June 25.
One thing that is a little bit of a worry is you see this right here. This company, I think it was called Tricolor. They're like one of the larger. Damn it, man! Why y'all making me not block my ads? I hate this. Where's the ad blocker? Reload. Okay, whatever. So Tricolor, it just went bankrupt. Remove from Chrome. Where is it? Get out of here. I'm going to read my article in peace, man. I turned it off already. Relax. Okay, now refresh. Now I'm going to get 100,000 ads for dumb things. Okay, so this company, Tricolor, which specializes in high-risk loans, they went bankrupt. But, dude, you were doing auto loans without a credit check? Like, how do you even have a business like that?
My guess 2008 great financial crisis shit.
Yeah, like this is probably some like, hey, 20% freaking APR, loans to people. Like I've seen some crazy dealerships. Like they'll be like, oh, you want this car? Okay, the APR is, like 22%, and it'll be like a used Honda Accord from like 1995, and because they can only afford like $100 a month, so they're like, oh, let's get you in this car, and they sign you up for these crazy stupid what are they called, financing deals. So they went out of business. The challenge is if this works its way up the credit cycle, I wonder if there could be some problems.
There could.
I don't think so. Yeah.
I mean, there's been more defaults. There's been more defaults.
Yeah.
But I don't think nothing that is of too crazy of concern. I think what people have done actually, who was it? Graham Stephan actually did a really good. I don't know if you watched it. I don't watch a lot of Graham Stephan, but it scared me because it basically said like people are now delinquent again on a lot of things. Well, student loans being one of them. But what is interesting is because mortgage rates have gotten out of control in terms of like mortgage rate used to be $1,500 and now the average mortgage is like $2,500 a month. People have to split it over 2 paychecks most of the time.
Yeah.
So people have expanded beyond the 38% rule that they're allowed to generally, and now they're splitting it up. So what those things generally count as is, they get paid at the first of the month in full, up to the 15th of the month or something like that in full. And what it doesn't count is if you end up paying in full by the end of the month, right? So it was interesting to kind of see. So it ended up just showing like, yes, people are doing creative financing with their landlords, right? Basically being like, hey, yes, let me pay on the 20th instead of the the 1st because I have to split it into 2.
Yeah. So the Federal Reserve, they do like this report, and they do a pretty good job of like tracking all sorts of different consumer categories of loan default rates. And you can like look in historically and see what the historical level of default is per specific item. So you can see here, student loans, their defaults have gone to almost 10%. But that's what the natural historical level was prior to COVID, when everyone got that student loan for moratorium. So that's climbing back up now. And then you have this right here, credit cards are at 12 now. So the only time where it's been like this was during the great financial crisis, where it went from like 10% to like 13%. So credit card what are they called? Defaults are going higher. Mortgage defaults are at an all-time low though. So I wouldn't, so mortgages are fine, but that's probably because people are sitting on a lot of equity. Auto loans are starting to kind of creep up. So like I said, the general consumer, it's not healthy, man. It's not healthy.
I mean, I would beg to differ. I mean, yeah, credit cards, yes, but and maybe that's a foreshadow. Maybe you're right. Maybe I'm being too optimistic, Chris. Like,
Yeah.
but if you looked at it, credit cards went up in tandem with mortgage and home ec in 2008 to 2010, and it seems like right now, at least, it's just credit card, and so it doesn't seem like it's all coinciding like it did back then.
So let's look at this right here. So page 12, which is 12 credit card number of accounts. So a lot of credit cards. Okay. So credit quality is starting to go down because during the Biden administration with the loan forgiveness, not the loan forgiveness, with the student loan moratorium, if you were not making your student loan payments, they were not reporting those to the credit bureaus. Now they're starting to report the things to the credit bureaus, and people's credit scores are starting to decline materially. And that is a problem because that means that a lot of these people are not going to have access to credit going forward. So, all right, this is good. This is perfect. This is what I wanted to see. So when you have severely derogatory and like all these other delinquencies starting to rise sharply, that's an indicator that we got a problem. So look at 06, Q1. It was around here. And then 07, it started to climb. 08 was here. So if we see a very similar pattern, we need to be careful of being in anything credit related.
Yeah.
You know, like look at the SoFis of the world. Look at the even PayPal's of the world. I would say the one to watch out for is the buy now, pay later people, because they're going to get absolutely demolished. You know, so if the credit quality among borrowers drops off, we got a problem. So right now,
it reminds me of Steve Carell and The Big Short, where he's like, the mortgage delinquency is at 4%. Either go to 5%, you know, the explode or whatever the fuck it was. Yeah, I remember that part.
Yeah. So right here, let's see, quarterly transition rates for current mortgage. See, mortgages are okay. If mortgages start to creep up, then mortgage defaults, then we got a problem. You know, but the thing is, so many people are sitting on 3% mortgages. Why? And they have a ton of equity. So it probably make more sense for them just to sell than to try to, you know, yeah, this is the other thing too, foreclosure rates. You saw this in 05, 06, foreclosure rates were starting to climb. Bankruptcies were starting to climb. Damn, what the hell is
They're
going
getting
on?
a lot more stringent. Like they don't have, like, they're not doing as many variable rate loans. They're actually checking people's credit. Like it was interesting. My loan officer when I bought my first place in New Jersey back in 2022, I was asking her, I was like, tell us about the glory days. And she's like, all you needed was a license. She's like, you didn't even need to send them bank statements. You didn't. She's like, you just showed up to the title office with a license. He's like, and you would walk out with a house. She's like,
Really?
she was like, there was no underwriting. She was like, you showed up with your damn check, and that was it. And like, and she's like, now she's like, it's fucking awful. Like, so.
Yeah, look at this right here. Transition to serious delinquency, which is 90% up. By age group, everyone is going up. That's not good. I mean, the economy is basically now getting to the point where everyone's got to stand on their own feet again. And this is going to be a transition. And so if the economy goes south, these numbers are going to keep rising, which means that we've got a issue with credit that we have to be very careful with. The other thing is, as you drain liquidity from the markets, you know, because remember, we are a consumer-based economy. So if you take away people's ability to access credit, you're naturally going to control inflation because people don't have the money to buy the widgets, you know, no matter what the price of the widget is. It's like, hey, people don't have the money to buy it. The price of that widget is going to go down. So people can say all they want, oh, we're going to get inflation is going to go back up again. And I'm like, with what money? Credit is going the other direction. People are not paying, getting as many loans. Tell me how you're going to get reacceleration in inflation, especially when, and this is, I'm glad that we brought this up, energy prices. Holy shit. What is OPEC thinking? Why is OPEC increasing production right now? The market's saturated. Are they trying to screw over the US wildcatters again? Is that the goal?
I've been trying to think about this one. So, I mean, if you want to, we could pull up the oil rates in the US. I think that we are peaking out in the oil rates in the US. So we haven't been north of 13 million barrels in a long time. Not oil prices. I meant like oil production, but
yeah.
But so I'm kind of sitting here like. Anyway, I think about this a lot. Obviously, what's that?
Who's the main guy? Who tracks the oil production? The rig counts? I forgot.
EIA.
EIA.
Yeah, I mean, obviously, I think about this more than I should because it's literally my job. But I don't know. Well, it's not literally my job, but I think about it because it kind of relates to my job. But it's I try to think about it because the Permian, that's still kind of growing a little bit. The Permian is getting tapped out, like I feel like if you were to separate this in now, I think there's still a lot of opportunity, I think, in the Four Corners area of the United States that hasn't necessarily been tapped out too much. Mm-hmm. But the Permian, man, it's pretty full. And you might get another 500,000 barrels a day, but I don't think you get another 1 million or 2 million a day out of the Permian.
Let me see what the production is like on by geography, because that could help explain.
I think you're getting about 6 to 6.5 million a day out of the Permian.
Okay, so this right here is the map of the United States with all the locations for oil and shale and everything else. So the most prolific and the ones that have like some of the best break evens is down here, the Permian Basin. This is the Permian, right?
No.
This is Permian.
No, the one to the southwest, the Permian's the blue on the western part of Texas. Yep. And then the really stacked stuff slightly over to the left as well.
This is Wolf Camp.
Yeah. So there's multiple different plays within the Permian there.
Yeah.
And I think the red there is the Austin Chalk. I think that's what you were looking at.
Yeah, that's the Austin Chalk. This is...
Sorry, I know a little bit about oil and gas.
Yeah. So oil from here is some of the cheapest oil from shale production in the United States, right? So a lot of our oil comes from here. There's other oil deposits up here in the north, but the cost of getting these is about $80 to $100 to make it worth it. But depends on like
what's
the driller.
What's too. That blue one in like Utah?
Is it this?
Utah.
Hold on. This is right here. So this
the blue. Yeah, I'm curious which one that. Yeah, that's untapped, bro. That's where I see a lot of potential, and I think a lot of that is there's not a lot of growth right now. I think it's going to grow at 10 to 20% a year, but unfortunately, that it's super. Not a lot of mom and pops, it's led by a lot of smaller companies. There's not a lot of majors in there because the wells are pretty good, but everything is by rail. There's no pipeline to get it out, and I think it's surrounded by. There's Richfield, right? We were talking about Richfield the other night. It's surrounded by native land. And so I don't think that you can build pipelines. A lot of it has to be trained out. rails.
how much is the gas over there? Like the gas rates, like is it a lot of dry gas there? Not dry gas, sorry. Is it a lot of like what's the production mix from gas to oil in that region?
I don't know. It's what I worked on. I don't know. I only have like experience on one specific reservoir in there, and it was very waxy. I don't remember what the gas oil ratio was. I don't remember.
Interesting. Let me know, man. Maybe
But the
we can go
Permian,
up
so
there
it's
and buy
like
some
to
land.
kind of explain where you're talking about though, like the Permian, so West Texas, that bluish, yellow, green, brown on the west part of Texas, that has pretty high GORs. And then same thing with that Eagleford, which is the South Texas stuff that you're seeing there. So the Haynesville feeds, that big yellow feeds into that handle on the end on the south part of Texas. That purplish, light purple. And that light purple has like an oil window and a gas window. And those have some pretty good GORs as well. But very good stuff over there.
Yeah. I wish I could let me just hide all these other ones and see if we can just isolate the ones that we're looking for. Let's see. So the Haynesville is, why does it not show Haynesville? Well, this is the Permian Basin. So that's what Matt was talking about. Damn, this is pretty good charting software. And especially if it's coming from EIA. This is the Haynesville area. I'm not Haynesville, sorry, Permian Basin. So this is some of the most prolific places that you can be. And the one company that has a lot of acreage over there is this one company, TPL, Texas Pacific Land Corporation. So if you had bought this company in like the early 2000, like, look at this, $26 a share. Right now it's almost $1,000. And all they do is they own the land and they own the mineral rights to that land and they lease it out to the oil companies to drill and do all this other stuff. But look at that. But it's fallen off a lot though. I don't know if you've seen it. It's actually come down from 1,400 to now like 900.
I mean,
probably because oil prices
super expensive at 14. It didn't make any sense.
Yeah.
And
oil
actually,
is cheaper. That's the
sorry.
thing.
Yeah,
No,
these mineral rights stuff is something that I've looked at, and not TPL specifically, but there's other companies that I've looked at for it.
Yeah. So you can see kind of like because of oil prices going lower, the oil realizations are down. So the one thing that they've been doing is they've been transitioning to services. And so one of the things that they're getting, they get royalty on the water, right? So that's been kind of helping them a little bit as well. So you can see their other businesses, and they've been taking some money and actually buying, I think, coal. I have to double check.
Coal rights or
coal rights, yeah.
Interesting.
Let me just double check. Was it coal, or was it a coal company buying oil rights? Yeah, it was a coal. Sorry, it was. I think it was the opposite. Buying, yeah, it was the opposite. It was the oil companies buying.
And that one looked pretty good.
Yeah,
I didn't like that one. I didn't end up going with that one though. And there was another like royalty company that I looked at, and I was like, meh. And I still might dabble, but I started buying some small non-operated companies.
So one of the things is from an investing standpoint, if you want to get oil exposure, and let's say oil has dropped off materially, this is the company you want to buy, because when oil prices rebound, let's say for some reason oil becomes $100 a barrel again, these guys are going to make money, because the valuation on the underlying asset becomes way more valuable, because a lot of the net acreage that's unprofitable right now becomes profitable all of a sudden, and you get this renaissance of leasing activity. So,
well, you also have to think. So you have to think like people always like try to bucket these things. Royalty companies are interesting because they don't actually have to do the operations themselves, right? So they're not paying for chemicals. They're not. I mean, this might be a little bit different because it seems like they are combining the royalty piece with trying to do management of like liquids and stuff like that. I don't really know much, but like you stated, they kind of have like services, right? And not a lot of royalty companies do that. so some royalty companies are just strictly royalty, and you can just basically they just buy overriding royalty interests, and you're pretty much just trying to buy them at the right price and hoping that people grow oil production, or gas production or coal production or whatever, lithium production, either whatever minerals, right? So anyway, that's something I was kind of looking at specifically, and then I stumbled across some non-operated companies, so something kind of like in the middle of the matrix of like you could operate these things. So you could be the one drilling the wells, you could be the one operating the wells, turning the chokes and stuff like that. And then there's the non-operated companies, which is kind of it's in between kind of the royalty owners themselves and the operators, but they own working interests, so they still have to pay capital for drilling the wells and stuff like that. Royalty owners do not have to pay capital for drilling wells. They literally just own the land. So no matter what, they're getting paid off the top end. When you're non-operated, you still have to help pay for some of the operating expenditures and things like that, but you don't have to worry as much overhead because the fact that you don't have the employees, right? So we always talk about gross profit, right? Gross profit's a big thing. You think about it, after you do gross profit, you have to subtract out SG&A. And if you don't have a large overhead base, because it's literally just you writing contracts and finding land to buy, and it's just you and 10 other dudes that are just wheeling and dealing, going around different basins to find land, you can make a shit ton of money. And so those are the kind of companies that I like to look for. And if they are able to find and get good reserve-based lendings at good rates, then hopefully when there's a good rebound. Anyway.
Yeah. I wonder if like they could build some data centers out here, because the gas, you remember like a few years ago, they were just flaring the shit out of it because there's no infrastructure to bring the gas to the main pipelines. So they just flared it, right? So now
it might be interesting for like Utah, like the Uinta Basin I was just telling you about, but at the same time, there's fucking nothing out there. So unless you can, but at the same time, if you're able to get the data there, then maybe it's good.
Yeah, I mean, all you need is some strong fiber optic connections over there, and the land is cheap. It's nothing there, you know. Maybe TPL needs to look at building some data centers out in the middle of nowhere. I mean, you could build a whole bunch of these. What are they called? The wind turbines. You put in some, you know, use some of the natural gas connections over there. So the cost of energy would be cheap as dirt.
Yeah.
You know.
So anyway, what I think is happening is I think we're at a peak now for U.S. oil production. Yes, maybe we can get to 14 million barrels a day, but we're not going to get to 20 million barrels a day or anything like that unless oil prices skyrocket. So I think what you're having is I think you're trying to see one of two things. I think it's been depressed long enough where you have the unruliness of all the different OPEC members. They all cheat, if that makes sense. Like they all have their production cuts, but they'll be like, oh yeah, we'll cut 500,000 barrels a day, but they only cut 250. Right. And so everyone else will start be like, well, they're only really cutting 250. Let me open up my chokes. Right. And so then everyone starts opening up their chokes a little bit more. And unfortunately, a lot of these countries are operating off of the revenue that they acquire from their oil and gas segment. And so it's just unfortunate. And there's this, you think about it, it's like, at what point does OPEC stop? Because if you look at OPEC, they've choked back enough. You have Guyana, who's brought on the majority of the, if you think about it, the demand hasn't grown like 5 million barrels a day. The demand since the pandemic has really only grown 1 to 2 million barrels a day. And a lot of that has really just come from Guyana coming online. And so if you think about it in reality, everyone else has choked back. It's really the United States and Guyana who have really helped offset the decline in oil rates.
Yeah. But that's the thing, right? From an inflation standpoint, that's perfect for us. Oil prices are usually a leading leader of cost for everything. Because I mean, you take oil prices, the price of oil, if it goes up, you've got input costs that start to dramatically go higher. And then you also got transportation costs So every good and service that we have is going to become more expensive to transport. So if oil prices stay where they are and actually come down, that helps control inflation a good amount. So yeah. So any talk about inflation reaccelerating, I doubt it. Colorado, I don't know. Yeah, it looks like they peaked out in 2019 and just chilling. Whatever.
Yeah, how's Utah look? Can you pick Utah?
Yeah.
Oh, sorry.
Utah right here. Got you.
See, that's what I'm saying.
Yeah, that production's up there.
It's not a lot, but it's 20% compound annual growth rate.
Yeah. I mean, look at how much they were producing. 36,000 barrels in 2023. Now it's about 189,000 barrels per day. That's not an insignificant amount.
No. And that's the problem, is they don't have the pipelines, and that's
their
really
limiting factor.
Yeah, I mean, if they had pipelines going into that Uinta Basin.
I'm trying to think. Who's one of the larger oil pipelines in that area? I think it's MPLX. They have. Actually,
That's definitely a hot Steve question.
Yeah. Oil pipe map.
And anybody that's watching on Chris's X, we are live on YouTube. I'll write the name here. We are live on Cashflow Chronicles TV.
Okay, so so this is right here. So this is what you were talking about. Frontier Aspen, which is Holly Energy. What the hell is Holly Energy?
Small guy.
I've never even heard of them. Holly Energy Partners. Let's see. No, they're not public. They got delisted. HEP.
Hepatitis.
Holly Energy Partners, blah, blah, blah. Midstream Energy, the company that operates pipelines, terminals in Western, blah, blah. As of 2023, their stock closed. So what did they get acquired or something? No, they must have been acquired. Or they went private, maybe? Holly Energy Partners. They still issue K1. On December, Holly merged with now wholly owned HF Sinclair Corporation. Wait, HF Sinclair. What does that sound?
That does sound familiar. I just want to give a shout out. 200 people for the entirety of the live stream watching on YouTube. And much appreciated. All of you guys have really been loving season 3. Getting to chat with Chris. We got some great people in the channel watching. We got Doug that just showed up. We got Sachin that just showed up. And literally countless other people that I've seen just supporting the entire night. So just thank you guys so much. It's always a blast.
HF Sinclair. So Sinclair Oil. So this is an oil company.
Oil?
I wonder if... probably what are they called? Midstream?
Talk about oil?
Yeah. So they have refining, marketing, midstream, lubricants, renewables.
You cooking?
You cooking? Yeah. I mean, this is the assets that they own. Because if the thing is, they're way more diversified. They're big. Look at that. I wanted to see if there's any sort of... Oh, there you go. Gas stations. I didn't even know they had a gas station distribution network. Huh. The Dino brand, wholesale branded sites. Oh, damn.
Never seen them before. I've never seen that Dino in the past, but...
Yeah, I've seen that dinosaur like when I've driven, but never really got to thinking about it. So they're trying to be like ExxonMobil or something? What's going on here? This might be worth researching. it seems like they're like vertically integrating their entire business. They even have renewable stuff. Let's see. Refining, renewables, marketing, lubricants, midstream, total capital.
Oh, kit and caboodle.
The debt is actually manageable. It's cheap. It's not super expensive. Yeah, we'll have to research it. Whatever.
Yeah.
See if there's anything there.
All right. Well, my food is getting here, and I have another chat. I promised a college kid he could interview me for his college project, so I'm going to scarf that down and get prepared for that. Mr. Patel, it's been a great hour and 50 minutes. Hopefully everyone enjoyed the advertisement free. No advertisements during the stream. Of course, I think you'll get one obviously when you click on the stream, but hopefully if you guys give us a thumbs up and subscribe. If you did not see an ad during the stream, that's the hope, as we give you guys back as you guys have given us back. As you know, that was a huge highlight for me, hearing you guys talk about how much value you guys got out of Cashflow Chronicles, and definitely made me emotional. Everyone kind of coming up, and I think that they were more so hoping that they saw Chris rather than me, but that's a different story for a different day. No, I'm just joking. But you guys are awesome, and if you guys do actually see an ad during the stream, of course, like right now while we're live, please let me know. Hopefully we are not. That's the goal, is to make sure, and I want to make sure that we're doing it right. But of course, if you're watching this after the fact, YouTube does put ads in. So if you're not watching this live, that's probably why you're seeing ads. So you guys rock. Thank you so much, Mr. Patel. I will see you in the back end.
Let's keep an eye on this H.E. Sinclair thing. There actually could be something interesting there. From like a long term, because it's about 3-point-something% dividend. If they're growing their top line, it could be something interesting. Guys, this is how research works. Okay, literally, we're talking. Oh, Utah's doing well. They need oil infrastructure. Oh, okay, who's the largest player over there? Holly Energy. Wait, who owns Holly Energy? These guys do. And now you can look at it and you can find value. And if this is how research works.
Oil.
Yeah.
Just kidding.
You cooking?
All right, thank you guys. Maybe we'll play the outro. Do I still have it on here?
Yes, go for it.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving!
Sell it all today.
Or look at it say, it's beautiful!
Welcome to the fucking show.